Welcome to the Question Hour, our live Q&A session with Mr. Sunil Subramaniam, MD of Sundaram Mutual. We recently concluded the stock market wrap, the second part in our two-part monthly series of Economy, Markets and Investments, or EMI. Without further ado, let's begin today's Q&A session. Welcome, Sunil. If you could give us a recap of what's transpired, from our previous session until now, that would be great, and then we can do the Q&A.
Thank you, Shweta, and welcome to everybody to this second question hour that we are doing in our series under the VShaped, which is called the EMI, Economy, Markets and Investment series. So I'll just give you a quick recap of since we did the stock market wrap a few days ago, right? Obviously, there have been some developments, and those of you who have seen it a bit earlier, this will act as a kind of refresher, and then we can dive into the questions, right? So as you can see in the slide here, right, let me just look at how the post-COVID world is shaping up, because I think we have covered the impact of COVID a lot, and I think March, the markets reflected the bad part of the COVID, and we've since seen a recovery. So let's look at why this recovery, and we'll start with the world at the first, right? Because if you remember, the global response to the COVID actually started with massive rate cuts and massive monetary stimulus, right? So as a result of which, if you see, the global policy rates had dropped dramatically from 2% to less than 0.5%. So about 177 basis points cut over the last 1.5 years. So cheap money and lots of money. The central bankers almost expanded their balance sheet by 30%. As you can see, US, Eurozone, Japan, UK, which are the G4, had a massive balance sheet expansion, right? So this gives you the each banker how much they did. And in addition to this, the government stepped in massive fiscal stimulus, right? So the fiscal stimulus pre-COVID to post-COVID, if you see, has been a quantum jump from 0.2% of GDP to almost 3.84% of GDP. So massive amount of money pumped into the world economy by the governments too, right? And the composition also designed to create a V-shaped recovery, because the focus was on the supply side. As you can see, job retention, business loans, unemployment insurance have been the main components of the fiscal stimulus this time, right? So as a result of this V-shaped recovery, so to speak, what is the update that's happening on the world economy as a result of these three combined effects: rate cuts, monetary stimuli, and this, right? So as we go down to this, let's look at what are the quick and easy ways to see the recovery, right? This is the Apple mobility driving trends, right? So people with Apple phones who seek on Google Maps or Waze or anything to how do I get from place A to place B. You can see how the easing of the lockdowns have led to a sharp spike across all the developed markets. At the same time, you look at people transiting. That was driving people. These are the transiting people. Even here you see a V-shaped recovery. Manufacturing surveys, right? Whether it's different states carry out different surveys, and you can see in the graph a clear V-shaped approach there, right? And you can see that it's gone well above 50, which indicates a positive bias, right? And in addition, finally, to tell you that air travel, global scheduled flights have gently started to come back, right? Now, so as a result of these three effects, a V-shaped recovery in world GDP is expected, to the extent that this year the world, as you can see in the table here, is expected to do a minus 4.9% negative GDP growth. Clearly the world in a recession. By very next year, it's going to jump to 5.4. So the world is expected to show a sharp V-shaped recovery the very next year. The breakup between advanced and emerging economies is given there for your information. So the reinforcement of that is what is known as the Baltic Dry Index, which gives you the shipping freight rates, which are forward booking of ships. So clear direction forward. And as you can see, from a level of 626 in March, because of the COVID impact, it's now doubled to 1264. A sharp rise in the Baltic Dry Index tells you that world trade is on the path of a V-shaped recovery. Coming to the Indian economy now, in the Indian economy, we had the big relief package of the government. I took you through in detail in my economic wrap, but just to let you know that under each one of those headings, which was supposed to translate at the ground, there has been significant progress. So you can read this. I'll leave this slide on for a minute. I don't want to run through it, but you can clearly see that where the public and private sector banks have now sanctioned 1.2 lakh crores of loans. They have approved purchase of 14,000 crores of portfolios from NBFCs. They've also released through NABARD about 248 billion rupees of the facility that was given. And the special liquidity scheme for NBFCs, HFCs, and MF5s, again, 33% of the financing has been received as of July. And other tax measures also, 2.4 million refunds have been issued by CBDT. So government, whatever they had promised, there is action on those fronts, right? And then from unlock 1 to 2, now you know that unlock 3 has also been announced. So a lot of economic activity is recovering, hopefully. And I will take you through a few updated indices to tell you that there is signs of normalization. So this is the 7-day moving average for the same optimal mobility driving index you saw for the developed countries. This is for India. As you can see, there's a gentle recovery beginning. This is another one, a motor vehicle registration. And I have shown you in the light blue, this tells you the average daily registrations in the last year, calendar year 2019, right? Clearly it was a dip, but it was more or less, whereas here, during the lockdown, can you see there was a sharp drop? And there was a small spike in April, again it reversed back. And now from May to right up to 18 July, can you see the trend has started rising? So clear signs of normalization here. Take the unemployment rate. And we have also shown the inverse of the unemployment rate, which is called the labor participation rate, right? To tell you the V-shaped how it looks. So clearly you can see that the unemployment rate has almost reached the pre-COVID levels in terms of unemployment. And again, V-shaped recovery seen in a whole of indicators. The CMI Urban Employment Index, air traffic, car sales, petrol consumption, Google Mobility Report, and in the NPI, National Payment Commission of India, you have the financial transaction. In all of these, you can see varying shapes of the V-shaped in progress, right? And this gives you a horizontal, I know it's hard to read, but just to let you know that across 10, 12 indicators, we have shown the May and June and last week comparison. And it can, as you can see, there is, although all of these, except for the last two, which is bank credit and bank deposit growth, which are positive, and in the middle, TV ads which are positive, all are negative, but they are less negative than the previous month. So indicates that there is a sign of normalization. Right. And there's the e-way bill generation rate. Government to government. Government is now doing all their purchases through e-way bills. Again, tells you about the V-shaped recovery in the e-way bill generation. Electricity, daily electricity consumption. As you can see, yes, there are starts and stops, lockdown, unseasonal rains. But overall, if you look at it on a trend line, right, you can see that last 7-day average is showing a sharp rise. And there's a general V-shaped approach there too. Right? And Jeffrey's TV ads index, clearly you can see television ads have improved purely because a lot of people like you are watching a lot more television and a work from home kind of a situation. So overall unemployment, India, overall urban unemployment, rural, all three given here. Can you see more or less they are mirroring the fact that the spike in unemployment seen due to COVID has now come back to the levels pre-COVID. So strong improvement in this, and as a result, Nomura's business resumption index shows the V-shaped recovery. It has just come to near about the pre-COVID level. Yes, it has to go up to the peak of 100, which was reached in the months of January, February, but at least the directional trend is fairly visible. So in India also, in the short to medium term itself, markets expect a V-shaped recovery. And that's seen in terms of the growth rates of the GDP here. And to put it in actual numbers, as you can see, these are the IMF's projections. This year, India is expected to be in a recession, minus 4.5 GDP growth. But the very next year, we are expected to jump to 6%. This is a faster growth than the world. The world, I may remind you, is minus 4.9 drop, and recovery is 5.4, but India is going to be at 6. So we are going to fall less than the world average, but rise more than the world average, right? So coming from here, just we remind you that the stock market behavior, which is what ultimately we are going to look at, is also by participants who look at the medium to long term. story. Quickly to revise for you, the long-term economic outlook is a story of the opportunity from China versus India, the strong structural advantage for India. To reiterate, India's labor supply is on a continuous rise for 30 years. China's is already, the red line is China, has already started declining. So labor supply wise, India has a huge advantage. In quantified numbers, China loses 21 million people in this decade of 17 to 27. India adds 160 million people. In addition to this, per capita GDP, which actually translates in some form to per capita wages, you can see that India is at 1/5 the per capita income or wage cost, as you may see it, of China. So Indian labor is much cheaper. Plus, we have adequate labor in all skill sets, basic, moderate, and advanced. And our country's ease of doing business rankings have shown a huge jump of 79 ranks in the last 5 years, the best among all the countries in the world. And we have also cut tax rates to invite foreign manufacturing into India to the level of 17% for a new company setting up, which is at par with the best in the world. So as a result of which, they've also given further tax benefits of DDT removal for FDI investments. And hence, if you put together an index of the attractiveness, whether it is financial, people skills, and business environment, India comes ahead among the most attractive countries for manufacturing. Hence, we expect the manufacturing cycle in India to recover. It will take a bit of time, but in the medium term, there are strong structural advantages for this to happen. And that's one of the reasons Indian markets are showing a V-shaped recovery. Coming to the money flows in the stock market, money is now not flowing into safe havens. Now, internationally, I just wanted to tell you first. If you look at it, gold, yes, in the V-shaped recovery, gold has improved by 15%. That means what? That the gold, which was having a 1-year return of 18%, because of the COVID went to 22, now is further. So while it has added, money is going, it's not going with the same intensity. The same with the US 10-year rates, which is fixed income, right? If you look at it, there's a 0.35 positive development, which means when money moves out of fixed income, interest rates rise. So interest rates have risen from, so whatever, 0.81 to 1.93 in December to this, and in the V-shaped recovery, you're saying that interest rates are further gone down. So that tells you that money is flowing back into equities. And if you can see here, though the Dow Jones as of this yesterday showed a 1-year return, which is negative, that was much more negative in the post-COVID. So there's a V-shaped recovery of 11.5%. NASDAQ being a tech-based index, and tech-based companies are expected to benefit from the whole COVID scenario, which actually shown a 27% increase. In 1-year returns, the same pattern is shown in the 3-year returns. So US equities indicates risk is coming back. At the same time, emerging markets continue to be risk off. In the sense, people are not willing to take a risk. One exception is our home country. I'll come to that in a little more detail in just 2 minutes. So as a result, even emerging markets, because their domestic economies are showing V-shaped recovery, their domestic flows are supporting. Though FII flows are still not going into the broader emerging market, their markets are already showing a V-shaped recovery, which means the recovery is more broad-based, right? And let's come to India. You look at it here, financial year to date, India has got $4.8 billion of flow. First quarter was almost 4 billion. The second quarter, already almost $1 billion has come in. Why? As I explained to you, there are FII investors who look at the medium and long-term story and are also expecting a V-shaped recovery in the short to medium term in India. So this FII outlook, which has turned favorable to India, what's the reason for that? Like I said, one is, of course, I already talked about the long term, but there's a currency. Because petrol crude prices have dropped dramatically, Indian currency is linked to the crude. So there's a stability which comes from crude price drop. The next is the rupee has already weakened by almost 9%, 8.63 on 1 year. So longer term rupee generally weakens by the difference in interest rates, which is about 5%. And hence, FIIs who see the Nifty, mostly they invest in large caps, are seeing that after a long years of flat Nifty EPS, they expect the Indian V-shaped recovery to show a V-shaped EPS also recovering. So from 454 EPS for this year, the next year itself, they expect it to jump by 50% to 677. That's the reason FII money is coming in, and naturally that comes into large caps, right? So the market naturally has shown a strong bounce back. If you see the 1 month returns, large caps have shown a 9% growth, mid caps 5, and small caps 4. And if you look at it, comparing 1 year returns of March versus now, and in the V-shaped recovery, actually, though the NSE mid cap and the BSE mid cap are very marginal, the fact is that they were very down in March. So if you see the V-shaped recovery, actually there's a small cap is recovered the fastest in 1 year returns, mid cap the next, and then the large caps has recovered. So let us try to understand why this has happened, right? So first of all, you look at it, the FII flows converted into rupees translates into the fact that they have put in Q2 30,000 crores, 29,500, and Q3 6,400 crores. MFs, however, since April, they have only sold. MFs have not been buyers in the recovery phase. Whereas if you see in the COVID correction phase of January, February, March, FIs were then selling because of the bad news, but domestic MF put all their cash at their disposal and went and bought. Obviously, they bought after the correction happened, right? So that's the story, that the recent recovery, Indian domestic MF have not been buyers. Why they have not been buyers? Because if you look at the inflows into mutual funds and split it as large cap, mid cap, small cap, right? You look at it here, 74% of their flows has been in large cap, right? 18% in mid cap and 8% only in small cap. So the rise in the index in the small and mid cap cannot be attributed to huge buying by the MFs, right? Then what is it that shows the uptake is the fact that new equity investors, people like you, digitally savvy, are going to brokerage houses like Zerodha, zero brokerage, 5 paisa capital, charging only 5 paisa. Look at their number of customers, clients. March and June of last year, it was around less than 1 million. Right now in June, it is almost doubled to 2 million. So huge amount of the purchasing in the mid cap and smaller cap space is happening because lots of people are trigger happy and buying things in the internet through stockbroking, especially those who don't charge them any fees. They're coming in because market correction, the TV channels talking about technical, saying this is at a 52-week low, that's at a 104-week low, and they're going and buying the V-shaped story, which is being talked about by everybody, including by me, and they are going and blindly buying those which are at their lowest. So these investors are otherwise referred to as Robin Hood investors, right? So they sit in the trees and go and shoot their arrows at these stocks. So that's the reason why you see that kind of a, right? And if you now step into the world of sectors, because mutual funds tend to buy sectors and they are guided by the sectoral strength. So this gives you a sense of the sectoral analysis of various indices, which sector. As you can see, banks and finance are the top in everything, right? So looking at the recovery from a bounce back perspective, this gives you the scenario. And as you can see, 1 month, most sectors are positive except the cyclical and industrial sectors. Using our typical analytical methodology of comparing 1 year returns of March and July, you can see that number one, I've given a ranking of which has shown the strongest bounce back, and you can see pharma and healthcare are the best sector. Why? Because any virus related vaccine or cure for bulk manufacturing will come to Indian pharma companies, and hence lots of Indian pharma companies are expected to benefit. That sector is positive. 2 is auto. Why? You just saw in the economic tracker, I told you that vehicle registration have bounced, plus last year was a bad year. So YOY, all numbers will look good if they do some sales. I know Maruti and a few other companies showed a loss this year, but that's because of their fixed cost. But if you project it into the future, you will see that YOY, there's a strong recovery. Other sector which is rated 3 is oil and gas. That's because Reliance Industries is classified as an oil and gas. That accounts for that. But what has not risen more is BankX, which is only risen 12%. Reality, which is only 9%, and power, right? So this tells you that the sharp polarization in the market, because the best bounce back healthcare is 53%, and the worst bounce back in the market is only 9%, right? Tells you there's a wide disparity in the performance. The same thing in the 3-year returns, right? So domestic MFs, I've taken the average of all the funds in the industry. domestic MFs have in the 1 month and 3 month returns, all the average returns of the MF industry has not beaten their benchmarks. Why? Just to take you back, in the large cap space, FIIs have been buying. Domestic MF has also been buying, but they've not bought everything that the FIs can buy. One. Two stocks, Reliance and Infosys, have accounted for a large part of the jump. Domestic MFs are limited by the SEBI rule saying you can't take more than 10% in one particular company, but FIIs are not limited by that. They can buy what they want, and ETFs, provident funds and all have also been buying. That's the large cap story. In the mid cap and small cap, it is because Robinhood investors have been just buying all those beaten down stocks, whereas mutual funds have a fundamental approach on that sector which is going to do well over the medium term, that stock which will do well over the medium term, they'd like to pick and hold. So what they picked in January, February, March, in the mid-cap universe is hard to sell off. So wherever there is conviction, they hold on. And the other stocks, right, which they would like to buy, they haven't got enough money. Only 18% of the inflows are into mid-cap and only 8% into small cap, I showed you. So there's not enough money for mutual funds to go and buy fresh mid-cap and small cap. Changing over their existing portfolio is also not easy because selling a mid-cap and small cap, given the liquidity constraint, is not easy. So that's why in the short run, the industry as a whole, MF industry, has not kept pace with the V-shaped recovery of the stock market. These are the two reasons for that. And however, if you then stretch it out to longer, because they do a fundamental long-term analysis to buy stocks and sectors, you can see that at 5 years, they are about flattish, but 6 years, 7 years, and 8 years, you can see how much alpha, which is the excess return the mutual fund industry has been able to add. So as you can see there, clearly over 10 years, the average mid-cap fund has delivered 3.64% per annum additional returns. And the average small cap fund has returned 5.2%, right? So that's what I would like to summarize my statement today, right? In terms of the fact that mutual funds are buying fundamentally good sectors, which may not have been necessarily part of the V-shaped bounce back scene for reasons I just explained. But over a medium term, the quality of the stock picking, the quality of the sector choice will come through and you will be able to get significant alpha from the mutual fund market. Right. With that, I conclude my brief summary of the stock markets, and now I'm happy to take questions. So, Shweta, can you please open up the question? I'll just stop the share so that I can answer.
So, our first question is from Jenny Shah. Yes. As an investor, what should be our next step? Wait or invest now? Are we expecting a W shape soon?
I must admit to you that what was seen as a strong V-shaped recovery in some of those graphs, in the last few weeks, there has been a flattening. So I think the initial sharp bounce back is not continuing with the same strength. What are the reasons for that? One is that as we have opened up the economy, we have seen that COVID has now sprung up in new places. Like Karnataka was very low, Bihar was very low. Suddenly they have all picked up. So in the process of opening up itself, the coronavirus is now coming again, rearing its head. That's one. Second is there are certain industries which have suffered significant damage and they will take a long time to really come back, like airlines and all of that, because even in the unlock, still interstate travel is not allowed and everything. So I would say that I would like to look at it not as a W. I don't expect a correction, but I would say that the shape would be a V and then a flattening of the short arm of the V and then another rise. So it will be a jagged V, right? I don't expect a W at this point in time based on the data. So I think a jagged V will mean that the short-term investors may come in and book profits when they see the next quarterly results coming through and those numbers not really being great. Right? Definitely their next quarterly earnings are not going to look good. That take it from me, because the previous quarter's earnings already showed that. And so short-term investors like these Robinhood investors may do profit booking when those results come out. And so there could be a little bit of a consolidation and a pause. So the markets, can they correct? So coming to a W-shaped, You said W shape, didn't specify economy or markets. So in the economy, I don't think there will be a W shape, but the market can see a W shape because one of the critical risk factors at this point in time is the US elections. And in the US election scenario, generally we have seen that in the run-up to the election, the markets do tend to correct in America. And then post-elections, it generally rise. Now, it's complicated by the fact that, I think Mr. Biden is leading the polls over Mr. Trump. So Trump was generally seen as pro-business. Mr. Biden has more left-leaning, centrist, more. But at the same time, it's good news for world trade because he's also less of a right-wing hawk. So I think he will reopen the NAFTA. He'll get back into Euro, NATO, and all of that. So I think there will be a little bit of uncertainty. So the stock market could see a little bit of profit booking and taking. And so there could be a small W shape happening in the markets. So I hope that answers the question.
So our next question is from Dheeraj Malhotra. What is the market outlook for the next 6 months?
So as I think my answer by and large covered. So for the next 6 months, I see a consolidation phase in the market. I think that for the bull, the rally to happen. So right now, this is a bear economic situation, BEAR, bear economic situation, which showing a bull market, stock market rally. So this is what is known as typically a bear market rally because there is no real yet short-term good news. It's all an expectation. So I would expect the markets to, in the next 6 months, to consolidate plus or minus 10% around these levels. So in one way to look at it is you can see a 10% correction from today's levels, not an issue, right? But I think that's only for the 6 months. I think the uncertainty post the US elections should settle down. And I think if you have a year's outlook, you should start seeing the bull shape form in the markets. So for 6 months, definitely I expect sideways movements with a plus or minus 10% as your band.
Right. So our next question, sir, is from Santosh. Why is the stock market rising when earnings are negative?
I think I did cover it in the course of my presentation that the market is not looking. So let me explain this. I showed you a lot of V-shaped signals, right? So the stock market is generally considered a lead indicator of the economy. What do you mean by lead indicator? The market rises or falls before the good news or the bad news in the economy actually comes to the front. Because economic data is collected, then published. But market participants, analysts of mutual funds, insurance companies, generally able to talk to the companies and understand the good times before they happen or bad times before. That's why the March correction happened before the actual numbers for the March came out in terms of company earnings. The same way, now while they're short-term looking bad, the fact is that the V-shaped recovery means they are discounting the bad news, saying the March correction already factored in this fall, but the rise that they expect, the market is now trying to read into that. That's what FIs are particularly seeing on India. Domestic mutual funds, like I said, are constrained by the lack of flows in their hands, and hence their purchasing definitely in this quarter has not been very much. In fact, they are negative outflows as far as their actions on the stock market are concerned.
Our next question is from Guru Simha. On what fundamentals do you feel the markets will continue to go upwards?
So I think the fundamental is the sharpness of the V-shaped recovery. So I think the slope, we all say V, but this is a V, this is also a V, this is also a V. So the slope of the fall now we know, but the slope of the rise can be very, very changed. So which means for market to go from its lows, which we believe March market was the low, I don't think any correction is going to take it below the March lows. So that's one thing. So March market being the low, to go back to the previous high, how long is it going to take is the question. So for that, for the market to get a sense of that, to get back, two indicators are very important. FDI flows, because for India's real broader market to grow, Indian economic growth is essentially dependent on the manufacturing cycle on the back of the opportunity being presented from China's situation. To capitalize on that, sadly, India doesn't have the money because any infrastructure capex spending, the government is going to cut in order to meet the fiscal deficit targets. The revised ones are looking like 6% at the central level. So they can't afford. So there's no money in the hands of the government to really kickstart the infra cycle. So foreign money has to come in. So for me, a sharp uptick in FDI is a great signal, because that money comes in, then we'll build factories, and it must come into real factories. It must not be your Paytms and Zomatos and Swiggies getting private equity money. So A, quantity of FDI, B, quality of FDI. These two things. The third number to track would be the capacity utilization. Today, capacity utilization dropped below 69. It was at a peak of about 76 2-3 years ago. Before that, our peak was 81% in 2011. So capacity utilization rising will mean a sharp jump in corporate profits because the fixed cost is already sunk. So that's the second indicator I think we should track. So if these two indicators we track, and that capacity utilization is a function of consumption story going up and all of that. So the consumption, other indicators will lead into capacity utilization. So I think if you look at consumption, and automatically banking will follow the track. But banks are first going to report NPA levels of record highs once this moratorium gets over. So the short-term news on the banking will not be great. So that can't be an indicator for you to buy, though I'm still bullish on the banking sector stocks, good quality banks from a medium-term perspective. So I think those indicators you can track. FDI flow, the quantity, FDI flow, the quality, and consumption of various consumption sector, and as a result, the capacity utilization in the Indian economy.
Our next question is from Dhyanukumar Shetty. Which debt funds are good to invest in this time?
So I would say that there are three categories of funds which I think are good bets at this point of time. So first is, if you're only looking for a savings bank plus return and you want anytime liquidity, then the whole range of liquid funds. There's liquid money fund, there's overnight fund, and there's money market fund and low duration fund. So this basket is meant only for anytime money. And today in money funds, you have the facility of ATM withdrawal of 50,000 rupees a day, 2 days in a row, midnight, 2 minutes before midnight, 2 minutes after midnight, you can get a lakh. So they are as effective as savings bank accounts. So that's one category. You can safely invest because SEBI has very tight guidelines on what you can buy, only 30-day instruments and all of that, highly liquid. So that's a good, safe place to play. The second aspect would be that you look at the banking and PSU funds, because these are banking and PSU debt funds. So generally and large, I know Yes Bank came and created a scare and 81 bonds defaulted, but by and large, the banking sector is a very protected sector by RBI. And I don't think defaults by banks on the debt market are at all going to really happen. Government will definitely bail it out. So I think that banking and PSUs also are owned by the government. So banking and PSU debt funds, right, will give you slightly lesser return than the other category I'm going to talk about, but they are safe. So if you're safe or safety oriented, I would say look at the banking and PSU segment. If, however, you are a little more risk taking, then there is this category called corporate bond funds. And there are many AMCs which run the corporate bond funds as pure AAA portfolio. So you can look at the corporate bond fund segment, provided you make sure that everything there is either GSEC, which is government, or AAA. So I think these three, if you restrict yourself, you can be reasonably safe. And corporate bond funds are also slightly longer duration. So you can also get any interest rate fall, any capital gains advantage over there. And there, if you hold for 3 years, you also get the taxation, long-term indexation benefit. So I would say stick to these three categories.
Our next question is from Kanhaya Paul. Is a rally still expected in pharma stocks?
Well, I think that I would say that the large part of the rally, if you saw the recovery numbers, it's 53% up. So I will not say the rally is over, but I think there is still enough juice, but it would be more company specific, depending on who has the kind of bulk drug manufacturing facilities for a vaccine or a cure discovered. So there would be a little more sector. Right now, it's been agnostic. All the companies in the sector have by and large benefited. I would say that it will get a little more company specific. So I would say that if you can trust your money to a healthcare fund of any AMC, that would be a better bet because they will do the reallocation of the portfolio. But I would say with a 1 year, 18-month outlook, it still remains a good sector to get a decent double-digit return.
Next question is the India story more hyped as every day there's negative news on jobs and layoffs and the markets are still going up?
So two things here. Yes, the India story is a lot of hype. I think that there is a lot of news channels tend to play up these things, and there is a lot of hype. But I think it's not smoke without fire. I think it's not all empty hype. I think that there's a earlier discounting. There's a kind of optimism building that things will come back normal quickly, which I think is belied. So that's why I said I agree with your hype story. But that being said, it does not matter that it is hype, because people are buying on the hype and the markets are rising on the hype. That hype is not going to get a disappointment in terms of a downturn in the economy, but a slower growth recovery. So the longer term players are not going to panic with that because they've got their own projections. Short term Robinhood investors could book profits and could lead to a little bit of a pricking of the hype balloon. So the second aspect I would like to say is a lot of the bad news is on companies at the MSME level. Job layoffs, this, or in the larger companies are in sectors directly impacted by the COVID and the lockdown, airlines, entertainment, those related areas. So if you ignore those segments, which any mutual fund would be underweight on today, you ignore those segments. The second point is that if you look at it, that these MSMEs are not in the stock market. The stock market companies will be largely insulated from this kind of a hype-based behavior, barring one or two, which are getting, as I mentioned, those company names earlier. So to me, I would still say in the stock market, you're still dealing with the cream of the corporate sector of India, where they have the ability to further put pressure on the MSMEs. And that's why the MSMEs will feel a lot of pain, but it will not reflect in their corporate earnings, right? So overall, all in all, yes, I admit that there is some degree of hype, but I think that the market is looking longer term and saying, yes, look beyond this current hype and let's buy the good quality ones. And I think you would be better off still trusting a mutual fund to make an investment in the stock market at this point of time. But like I said, with a 3 to 5 year perspective, which remains our story always.
Our next question is on our mid-cap fund. Could you please share when it could recover?
So maybe I can use this opportunity to share a slide on the fund itself. Pardon, just so if you see in the V-shaped recovery, our funds have also shown recovery. I've listed all our funds here. So if you see mid-cap has from the March bottom, it's still a 1 year 5% negative, it's still a 3 year 18% negative, but there has been a recovery of 25% since the March downturn. Admitted, like I showed you, mutual funds have not captured the entire bounce back. That's because we still believe in the quality of the companies we buy. So my thing is to tell you when the mid-cap would come back is a question depending on the slope of the V-shaped recovery of the domestic economy. The faster the domestic economy recovers, the faster our mid-cap funds recover, because we are very correlated to the India story. Right? That being said, let me show you some track record of the fund in terms of the way it's performed. So if you look at it here, right, this is the mid-cap fund compared to the Nifty mid-cap. See, when over a longer period on a cycle, the fund definitely does better than its benchmark. In short times, it doesn't capture it because it's doing a fundamental approach as opposed to Robinhood kind of investors buying specific stocks in the benchmark. So if you see here, there's a virtuous cycle, vicious cycle, virtuous cycle, vicious cycle. You can study this data. I'll not go through the entire thing, but I will draw your attention to the last two columns. So if you take October 2013 to December 2017 was the last bull market in India, this previous one. In that bull market, the Nifty Midcap 100, which is the benchmark of our fund, went up 28%, whereas per annum, mind you, whereas mid-cap fund went up 34%. So 6% excess returns it delivered. At the same time, look at the downturn. From December 17, the stock market has been down, especially the mid and small cap segment. So there, the mid-cap index fell 14%, as you can see in the rightmost column. Our fund fell only 13%. So when you see over a cycle, the fund manager definitely, the active management, adds alpha and does better. But that being said, yes, over this period from 2017, the investor has had a negative return, whether it's benchmark or otherwise, right? I admit that. So to take you to another method of analysis, of a rolling returns analysis, if you see here, 1 year, 3 year, 5 year, 10 year, 15 year, I've compared. The first column here tells you rolling return means is the best way to judge the past performance of a fund and your expectation of future performance. So as you can clearly see, whether it is in average returns over 1, 3, 5, 10, 15, or it is in max returns over 1, 3, 5, 10, 15, the fund has delivered better than the benchmark. Whenever it has given, whatever average returns have been better than the benchmark. Whenever it has given max return, it has been better than the max return ever given by the benchmark. And the loss also it has protected. So the green color itself tells you about the superior performance of the fund compared to the benchmark. But like I said, it's about a waiting over a period of time. And if you look at the probability factor of getting positive returns, you get losses, right? So as you can see in a 1 year, the index 72% of the time versus fund 76% of the time it gave positive returns. So 24% of the time it gave negative returns in 1 year. But as you wait for 5 years, you can see that there is a zero probability in the fund of getting negative returns. So over the long term, the fund manager is able to protect your capital, and the percentage of beating inflation over 5 years is 94% of the time. I admit that today we are in that balance 6% time, because the economy has not been doing well for the last 2-3 years. The mid-cap space has not been doing well, and the fund has suffered that thing. So that 6% is happening now, but over a long period of time, the quality of the fund management is clearly seen from the fact that he has protected your capital and given you inflation-beating returns more number of times than a benchmark, which is the ultimate comparison, right? So I trust that gives you. So my request is just be patient. As the V-shaped recovery plays out, the fund would definitely bounce back.
Yeah, our next question, sir, is from Ravi Makar. Please suggest for a 25-year long-term or a retirement goal, which Sundaram mutual fund would you suggest for SIP, 10,000 rupees monthly?
Can you repeat the first part of the question? Yeah. Over a 25-year?
For 25 years, SIP of 25 years, 10,000 per month, which schemes of Sundaram Mutual would you suggest?
So over 25 years, definitely I would suggest the mid-cap fund. Because while there are short periods of underperformance of the mid-cap segment and of the fund, over a longer period of time, because the fund, by and large, top 10 stocks are held for 4 to 5 years, tends to deliver that value. So if you're taking a 25-year story, you've got to believe in the India story, and the mid-cap fund is closely aligned to the India story. So I would say close your eyes and trust your money to the mid-cap fund for a long-term 25-year investment. I think the track record over the last 18 years has been 20% plus in terms of returns per annum. So I think the past track record also speaks for itself.
Our next question, sir, is from Mitesh Merwat. About the series of closed-ended mutual funds launched by Sundaram, will returns pick up?
So definitely, I think that the returns will pick up because they are all even more closely linked to the domestic economy and the V-shaped recovery as it pans out. I think that in a year's time, definitely that recovery will be visible, and the stock markets discount the future. I think so in a year's time, definitely there'll be a good bounce back in that story. So I don't think that's a cause for you to worry too much. I think there'll be recovery. The worry would be about those of the micro caps which are going to fall due in the later half of this year, because you've got to give a bit of time for the economic recovery to play out. And so what we are doing is we have just taken approval. We have 2 funds in October and November. We've taken approval from SEBI and our board to extend that maturity by 1 year, because we think the story 1 year later would definitely be better. So I would suggest that if you are investing in those funds which are maturing in the next 2-3 months, we will come to you with a request to sign up for an extension. And if you can sign up for that, I'm sure that we are hopeful and optimistic that we'll be able to give you a much better NAV than it is currently reflecting. But yes, those funds have underperformed given the fact that micro caps have suffered even more than small caps, which have suffered even more than mid caps in this whole economic downturn and COVID. So I think that, yes, they are definitely underperforming at this point, but an extension or a year's time would definitely be helpful to help improve the performance.
Our next question, sir. Yes. Many AMCs have 1 or 2 flagship funds. What are Sundaram Mutual's flagship funds?
So our primary flagship fund is the mid-cap fund because it launched in 2002. It's given 20% plus annum returns. I just demonstrated in a slide to you how on a rolling returns basis or on a good cycle, bad cycle basis, it has consistently done better than the benchmark. So it is our flagship fund because we were among the first to launch a branded mid-cap fund and have managed it successfully for almost 2 decades now. So clearly that represents one of our flagship funds. The second flagship fund, if you ask if you said 2 or 3, I'll pick 2 more of my funds. I would also point out to our concentrated large cap fund called Select Focus. It's currently a 5-star value research rated fund. It's a 30 stock portfolio which picks and dynamically manages it. In fact, recently we launched a webinar called the Anti-MF, where I spoke about the fund in great detail. You can look at the YouTube for search for the Anti-MF, and it's a full-fledged presentation of the fund. That fund also launched on the same period as Midcap, has delivered 18% per annum over the last 18 years. So again, a good performing fund and something that represents the philosophy of the fund house very well. The third fund, which we see as attaining flagship status, given the fact that having built up a track record in mid-cap and in concentrated large cap, we'd like to offer to investors a more broad, diversified, less high risk, high reward than these 2 funds to the investor, is a fund called Sundaram Equity Fund. It is a multi-cap fund. Currently, the portfolio has about 70% large cap, 20% mid cap, 10% small cap. So that's why we named it Sundaram Equity Fund, because ultimately, in let's say 3 to 5 years from now, I would like that fund to assume the status of the flagship, because we would like to provide a more blended risk reward fund to our general investors, because both the mid-cap fund and the Select Focus fund are in a sense high risk, high reward, and it represents what Sundaram's skill sets were in managing high risk, high reward. But we are also metamorphing as a company, as we now 1.8 million investors with us, and actually with such a large investor base, we'd like to offer like I said, more moderate risk reward products, and hence Sundaram Equity Fund I would choose as the other flagship fund from our accounts.
Our next question, view on Sundaram Rural India Fund.
So the Rural India Fund is no longer a Rural India Fund. The name has been changed to Sundaram Rural and Consumption Fund, because some years ago, when it was a Rural India Fund, was launched with the idea of taking advantage of the rural infrastructure, rural agriculture and all of that. Over a period of time, with the monsoon's vagaries in terms of some years drought, some years monsoon and all of that, we have refashioned that fund into a more consumption-oriented fund. All being said that it will try to focus on the rural consumption story. It will carry agriculture and monsoon and the fertilizer and those stocks, but to a limit of about only 10%. So it's largely a consumption play today. So the rural consumption play, which is what its core theme is, I think is enough for a good wicket this year, because the monsoon forecast is good, the Rabi harvest was good, and the Kharif sowing is good, as seen in the fertilizer demand picking up. So I think the immediate outlook for the fund looks good, because this extra cash in farmers' hands and the fact that COVID has not affected rural India to anywhere near the level that it has affected urban India, means that rural economy is on a fast track to recovery, more money in the hands of people, and that evidence is already seen in terms of the vehicle registrations, which are largely in rural India, going up, two-wheelers, tractors, all of that. So I think the story for the foreseeable future looks to be good, but please bear in mind that it's not an agri fund, and it's not a pure rural fund, it's a rural and consumption fund. And rural consumption is the story that it plays out. And we trust that it is a multi-cap portfolio. I think it is about 50% in large cap and 50% in mid and small cap. So it's well portfolio as a multi-cap portfolio. And definitely you should look at it. If you have an advisor, do consult him before you take a call, because bear in mind, it is a sectoral fund. So it is highest risk reward in the whole risk reward spectrum. So kindly take that in mind and take the advice. If you don't have an advisor, you're welcome to call up our office, and our office also can help you, guide you in terms of how to look at that fund. Because it is a sectoral fund. Sectoral funds are more high risk, high reward than generally diversified funds.
Our next question is from Vinay Ahuja. He states that MFs will only recover after markets crash once again, and the rally has been very narrow. He wants to know if you agree with this.
So there are two parts to your question. The second part, I agree, which is that the rally has been very narrow. Yes, I mentioned 2-3 stocks in the large cap space, a whole bunch of small cap stocks bought by Robinhood investors. Yes, it's been a very narrow rally. I agree. But whether the markets have to crash to recover, I doubt it, because I think that the Robinhood investors may book profit, and those parts which went up may come down. But mutual funds anyway have not high exposed there. So to that extent, that the reasons that mutual funds have underperformed in the V-shaped rally, any V-shape, any correction in those stocks, they would also be relieved of the pain there because they never bought it in that place, because they don't qualify from a fundamental perspective for purchasing. So I don't think MFs are in for a correction before they rise. MFs have risen slower than the market, but they will continue to maintain a rise, whereas the market can go through a significant year of volatility as lay investors, digitally savvy investors who are buying some things may tend to book profits and move rapidly in and out of stocks. So I would give a qualified answer to your question.
We've received more questions than we can answer. So in the interest of time, we will be taking only 2 more questions. For the others, we'll leave responses in our comments section. So the next question to you, sir. The small cap index is up, but why is our small cap fund's performance not in line with the benchmark?
I think I covered it in detail in terms of the Robinhood investors buying and showed the average of the industry. And I'll tell you that our small cap fund, if maybe I just share a screen to tell you how it catches up over the medium term. So let me put back the slide which I had. And I wanted to point out to you 2 things in terms of the small cap fund is first, look at it in terms of the vicious cycle, virtuous cycle, right? Over a period of a cycle, right? If you look at it, take the last virtuous cycle, when the Nifty Small Cap 100 index was up 30%, this fund was up 39%, 9% per annum additional returns. Now in the down frame from December 17, while the index is down 24%, the fund is down only 20%. So your point of view, I recognize that the short uptick that you see in the graph, that the fund has not captured as well as the index. And the reason for that is the Robinhood kind of purchasing that has gone through. So let me take you to, I'll just blow up this so that you can see it better, right? I hope you're able to see relate to the numbers that I spoke about. Now coming to a rolling returns methodology analysis, as you can see here, across the category, 1 year, 3 year, 5 year, 10 year, and 15 year, the average return of the fund has been better than that of its benchmark. So over a period of time, it does catch up. The max return of the fund is in green territory throughout. Yes, it does catch up. And in terms of, except for a 5-year period where it's taken, the negative returns are there in the index and in the fund. But if you can see the delta, the difference, it is always in green territory, which means it has not given you as worse a loss as the index. So the quality of the fund management comes through. The other way to look at it is in terms of probability, the percentage of positive returns. So if you look at it from a perspective of percentage of probability, obviously small caps are higher risk, higher reward. So in a 1 year in the index, 42% of the time you suffered losses. That's the nature of the beast. But this fund, again, only 38% of the time has given you losses. So you see the green tabs around the diffs, it tells you that in percentage of positive returns, it has consistently done better than the benchmark. And in a 5-year period, 97% of the time, it has given you positive returns. So I think that's an important factor to consider, right? And the probability of beating inflation also has been very, very strong. So as you can see, over a long period, the fund does catch up, but 2 things in terms of its recovery. Like I said, first, a clear path to a domestic economy's V-shaped recovery has to be observed for this whole segment to do well. So our micro caps are even smaller than small caps. So it's related to that answer also. But I would say that the recovery of the fund to come back will depend on the pace of the domestic economic recovery. The recovery doesn't actually have to happen, but must be visible for the markets to start discounting. So it can happen anywhere between 9 to 12 months. It can happen before that also. I hope that answers your question.
Our last question, sir. Does Sundaram Mutual plan to launch a gold fund?
No. I think that we don't have the expertise to understand gold or commodities. So we don't have a commodities fund too. So we don't have the expertise to do that. So we don't plan to launch a gold fund in the near future because hiring a dedicated fund manager for that and getting enough of corpus, it doesn't form part of our core philosophy at this point in time. If our view and thought process changes in the future, we'll let you know. But as things stand, we do not plan to launch a gold.
That brings us to the end of today's Q&A session, sir.
So thank you very, very much for your patience. I think we have spent almost an hour in the process of Q&A. Very, very intelligent, very probing, and very nice questions. Thank you very much. It has given an opportunity for us to expand our Sundaram Mutual's thought process on the economy and the markets and how we see the way forward. I hope you found it useful. Look forward to meeting you in the August editions of our economy and market stock market wraps, as well as on the question hour next series. Thank you. All the best. Stay safe through this period.